Hey everyone, welcome back to another episode of the Meet Kevin Show. Today we've got a lot to talk about because we got to talk to some industry execs and professionals about what's happening in crypto. These rumors we're hearing about the complete collapse of crypto. Would Bitcoin potentially ever go to zero? And we got to start off by asking Mr. Wonderful, a strategic investor in WonderFi, and Ben, all of us, we got to talk about the collapse of Voyager Digital this morning, even after FTX's Sam Bankman Freed came in and bailed them out with an over $450 million loan. They're still filing for bankruptcy. And now individual investors in the platform and retail investors can't get their money out. Folks, Kevin O'Leary, I want to start with you. What's happening here? And then I want to hear from WonderFi and maybe how things are different with you.
You know, this is nothing new in the story of leverage. And so in every cycle, what happens is various actors, companies, take on more and more aggressive positions using leverage to goose returns, which is age-old. It works. It definitely works. Now, what you're going to find in this situation is many crypto operators, particularly lending platforms, have never operated it with such volatility before. So they were in the slow growth from Bitcoin, almost a decade ago, from $800 all the way to $60,000. And all along the way, some of them became really aggressive in using leverage, which is the traditional hedge fund model. Now, what happens, and this happens in equities, it happens in bonds, it happens in real estate, it happens in crypto. Crypto's the Johnny-come-lately new asset class with a whole lot of newbies in it. You're going to see a whole series of these actors get crushed to zero over the next few months. In the contagion of leverage being caught offside with the lack of liquidity. Voyager is not that big a deal. It's kind of irrelevant in terms of, this is a diversified shareholder base. It's not FDIC insured in any way, so it's not putting any stress on the government systems in any way. All the shareholders should consider themselves educated, no different than when you go to Las Vegas, put it all on black, and it's red, you lose. That's exactly what's happened here. But the great news about this and why this is so good for the market and how this helps the crypto market is it educates the business models that aren't going to work. So it's like taking a big spatula from the sky and scraping all the crap out of the market. And it's going to happen very, very quickly. So anything that was built on a business model that is not going to work or can't sustain volatility is going to be gone. And it's a good thing. It's a wonderful thing. It's going to leave the industry much stronger. Yes, we must mourn the investors that got wiped out to zero, but even they are better off in the sense that they've been educated.
So how do you know what's safe? Kevin O'Leary, what do you look for in a company to know? Because Voyager was a public company. We could look at their statements and their filings from March 31st, and we see, well, they had money, and the CEO in interviews told us, hey, we only lend to qualified institutions, or we lend the bulk of our money to large institutions. One of them ended up being Three Arrows Capital, where they lended 33 cents out of every dollar they lent to, who got completely wiped out. So how do we protect ourselves even with public financials?
You own crypto without leverage, and you understand your counterparty risk. Don't worry, by the time all the litigation is over from all these bankruptcies, you'll know everything about everybody. Lawyers are really good at doing that. And there'll be tons of class action, if not just straight on litigation, to go after any assets they can get. And that is sort of, when a fish dies in the ocean, it goes to the bottom, and that protein is reprocessed by slugs. And I'm not saying lawyers are slugs. They have more than single cell proteins, but they know how to get the last drop of any value there, and they're going to get it. It's going to take 5 to 7 years, but all of this is good. So when I hold crypto, and I know it's very volatile, I have zero leverage in any of my positions because I know tomorrow morning I could wake up down 38% in any token, any coin, any project. And really, that's exactly what's happened. So, but if you put on leverage, you learn the very, very important lesson. You go to zero.
Ben, I want to ask you, how are you different at WonderFi? How are you not lending to hedge funds like Three Arrows Capital? Or if you are, how do you vet them differently? What's different about you? Why are you not going to be a BlockFi or a Voyager?
And this ties back into the question you just asked Kevin, which is how does he decide what's safe to invest in? And one of the things that he has been talking about for many years before he even got involved with crypto was just about compliance and regulation, and obviously coming from the world that he does. And so that is the difference with WonderFi and BitBuy and Coinberry, which are a couple of the brands that we have under the WonderFi banner. All of our platforms are regulated by securities regulators in Canada. And what that means is when we offer products, we have to vet them with the regulators. And so we have to go to the regulators with a plan around how we're going to actually implement something like staking, for example, be able to assess the different risk profiles, have a bunch of processes and backstops in place before we can actually bring that product to market. Now, when you look at a platform, not to single out Voyager, but just as it's in the news, that is something that did have some state licenses in the US, but really didn't have the oversight of a regulator like the SEC or the Ontario Securities Commission in Canada. And so products that they're offering, like that offer yield to customers, and that's what we're seeing implode right now. No regulator had been looking at that or had vetted that to see what types of risks exist for the business and for the customers. And so the regulation piece becomes extremely important. And I think these events with Voyager, with Celsius, and with BlockFi, which are all happening around the same time, this crypto liquidity crisis, that going back to what Kevin said, it's an education for users and for shareholders. It's also part of the growth of the industry. So we will see regulators focus on this particular issue going forward. And we can look back at the evolution of crypto over the last 10 years. There's been significant events like this before. I see this as sort of the second wave of crashes in crypto that lead to specific types of regulation. The first was in 2016, 2017, where you had crypto exchanges that were run by individuals who would basically have control over all customer funds. So this is not even talking about, lending or anything like that. You would deposit funds and then it would, go into the CEO's pocket basically. And so that led to a bunch of these debacles with Quadriga and other things that led to CCAA and people losing tons of, insolvency and people losing all their funds. And what came out of that was regulators now saying, crypto exchanges that are regulated need to have a third-party custodian that holds customer funds. It can't be in the CEO's pocket. And so that it's obviously in hindsight, it makes a ton of sense, but we needed to have that those incidents happen. And so this is, I think, the second wave of that.
Yeah, that's really interesting because you do get companies that like Voyager Digital, I'll put it up on a screen here. They have these disclaimers at the bottom that say, hey, they're a FinCEN registered company. They file public disclosures because they're a public company. And so it's certainly challenging at best and at worst, just outright discouraging and confusing for the retail consumer to know, hey, like, who's regulated the right way? Like, which license am I looking for? And so I guess the question now is, what's safe in this kind of environment? And I'm going to start, Kevin O'Leary, I want to hear your take. Are stablecoins safe right now? Or do we need to be worried that if Bitcoin drops to 10K, we're going to see the Gemini token go under because of all this over rehypothecation? Or worse, USDC goes under, and then any company that's offering staking risks some form of stablecoin meltdown. What's your take on that?
Well, let's talk about that specifically, because I think it's a great topic, and for several reasons. Reason number one is people think that crypto, the entire sector, is going to get regulated all at once. That's not going to happen. The most likely scenario, and this is a personal opinion, but one I've been working on in Washington, along with others, is that we would like to get policy on just stablecoins first, because stablecoins represent a very powerful and efficient payment system. And we think we can get bipartisan support between both parties supporting the American dollar as a default currency for a global payment system. It's not going to be the Chinese yuan. It's not going to be the Swiss franc. It's not going to be the euro. It's not going to be the British pound. And the reason it would fall and default to the US dollar would be that is the currency used to denominate most commodities. And so the challenge you have right now, and why there's so much pressure to solve this, is it's very inefficient to transfer US dollars over to Geneva, then put it into Swiss francs, and then buy Swiss Nestle stock or whatever it is you want to do over there. It's really slow, very inefficient, very costly, not transparent, and not easy to audit. And so all of that problem goes away with a stablecoin. Now, the proposed policy that you'll find in granular form in both the Haggerty and Toomey bills, and I've met with both of them as many others have, this is very simple policy. What it looks as, it says, okay, for any stablecoin, an audit every 30 days. And any asset underlying, holding up the value of the coin or token, cannot have a duration of more than 12 months. Now, you've seen that policy before. It's called a money market fund, and you'll find it at Fidelity and Putnam and many other financial services entities that are FDIC insured. Circle, if it wished, that issues USDC, could become a bank. They could be FDIC insured if they wanted to, but they are sort of leading the pack with crypto in terms of payment systems under a stablecoin that has not broken a buck. So you've seen even Tether trades below $1, it's 0.999 right now. And so when you break a buck, you lose a lot of confidence. So what I'd like to see happen here is that we regulate stablecoins first because of their utilitarian value within the crypto universe, and that get done in this calendar year. And the reason that might happen is Toomey is retiring, and he is a driving force, as you know, on the Hill, and is really behind this momentum and this bill, and has lots of support from both sides of the aisle. So I think that's good. Now, obviously, what happened to Luna is an example of what not to do. So again, a sad situation, billions lost, but a great education to the market. Algorithm-based stablecoins, I don't think we're going to do that again. I'd rather see something backed by US dollar or assets that are very liquid, that can have duration of less than 12 months. So that makes sense to me. So at the end of the day, the bad ideas get removed by the big spatula. And again, it's unfortunate for those investors that didn't think it through, but not all stable coins are alike, USDC being the leader currently. Now, having said that, if you go look at current yields across the spectrum of duration from 1 month to 12 months, it's only 50 basis points right now. So right now, USDC, while it hasn't broken $1, is not a great place to park cash because you can do 1.2% in commercial money market accounts in US dollars. So at any one time, you have to manage assets as you always had to. I think USDC, when things stabilize and there's more demand for it, will probably have rates 300 basis points higher than 1%, but you just don't know. And when you were putting out loans on USDC platform, it would have been best to ladder them from 1 month to 12, so you'd still be accruing 3 to 4%. But everybody's learning. That's my whole point. That was a long dissertation about what I think is going to happen in stable coins. But if you're going to be in a stable coin, it's only a personal opinion, USDC is the one that has not broken a buck recently.
Yeah, and so I want to ask a follow-up to that and then go to Ben. The follow-up is a lot of folks, I don't believe, realize that when they do stake a USDC stablecoin, even though that coin is backed by $1, if it's then lent out, that person no longer has the right to the claim of that dollar. The person whom the coin is lent to has that right. And I wonder, is there a risk that companies are leading a lot of retail consumers to believe that, oh no, you can always rename it for $1 without mentioning that, oh, but it's leveraged out 10, 20, 30 times. And Ben, I'm going to end up asking you after Kevin O'Leary here, how many times are these stable coins lent out? Do we have any idea about that? But Kevin O'Leary, for you, isn't that a risk if you take yield that you're actually becoming a lender? And if we have systemic shocks, or at least certainly going through a bear market, that you could even see a USDC break a buck. And even though it's backed by $1, the people who lent out or staked lose, and the last person who's not staking it out, they get the $1. What's your take on that?
So that's where you need management and compliance and total transparency. And so those who have opened accounts with Circle itself, managed it under corporate accounts, understand exactly what you just disclosed. But also the company is constantly monitoring its margin requirements and exactly what it's got and what it's holding. And if you have an account with Circle, you're getting a constant stream of information answering exactly those types of questions, because they have their brand to protect. They also have that dollar strike value to protect, and they have their corporate accounts and account holders to protect. And they want to do that. They want to emerge from this successful, even though it's been tested with volatility. And I will remind you that recently it was disclosed that both Fidelity and BlackRock each invested $200 million in the Series F of Circle. That is a huge vote of confidence in the middle of all of this volatility. We're talking about the equity of the company. And so they're the most conservative money managers on earth, putting a bet forward on Circle becoming at least one of the regulated cryptocurrencies that are stable. And so at the end of the day, you know, they have the risk too. We all have risk. But if I have to bet, I'll invest beside Fidelity and BlackRock, and that's exactly what I did.
Ben, your take on stablecoins, and what do y'all do at WonderFi? How is that sort of, when individuals stake, how do you handle the disclosures for that? But also, more interestingly, can you give us some insight into how often are these stablecoins circulated through the system? Is it, somebody deposits $100,000 and then that gets cycled through 5 times? Is it 100 times? How many times does that lent stablecoin sort of move around?
So yeah, a couple questions in there, and I think I love the root of all your questions comes back to there's a lot of retail confusion about products and licenses and what's regulated and what's not and what the risks are. That's what it comes down to. And even for sophisticated people, like you pulled up Voyager's website, okay, it's a public company, it's licensed by FinCEN, there should be some comfort level with that. And as much as compliance and regulation can be a boring thing to talk about, and I'm actually a lawyer in a previous life. One of those bottom feeding fish that Kevin mentioned, or whatever the phrase was. But as much as I try to get away from that, that's really the DNA of what we're doing is really around regulation and compliance, and so much of that comes back to disclosure and really helping customers understand what the risks are. So just to kind of cycle through a few of the topics and questions, I think for users that, because this is just going to become more and more important, especially in light of some of these incidents now. So, with FinCEN and FinTrack, those registrations, they're not actually protecting the customer. They're really focused around anti-money laundering rules, and there's not a customer protection that lies in there. It's really the licenses with the SEC or the OSC, the securities commissions, that have these mandates of protecting investors and users now in the crypto space, now that they've asserted jurisdiction over that. So those are the regulators that are making sure that customer funds are held by a third-party custodian, that if platforms like WonderFi or BitBuy or Coinberry are doing staking, that they've vetted the process, as in the regulators have vetted the process and they're comfortable with it. And so, tying that back into what we do, we actually don't offer staking through our platforms yet, but we've been in discussions with the regulators for quite some time. And there's always pressures to bring new products to market. And obviously I face that in my role, and we face that as a company. But at the end of the day, in situations like this, it's better to be a bit slower moving and make sure that the products that you're offering are safe and secure for customers. Because at the end of the day, this is no longer just an early adopter crowd that we're dealing with in crypto. You're now really getting into closer to some mainstream adoption. So you're getting people that don't have necessarily the sophistication or background of crypto trading for years. And so there's a lot of additional risks that come in for those users. So I think it becomes more and more important for companies to be clear about what the risks are with the platforms. And I know a big topic with some of with the liquidity crisis with some of these companies we're seeing is that there weren't really proper disclosures around what's being done with customer deposits, and that's crucial. And so I think that's going to get weeded out with this, and it's going to become something that I hope retail users can will be able to address easier. And I think it's great that you're talking about this and bringing it to the top of your agenda, because at the end of the day, this is also a place where people go to learn about crypto and how to access it and what the risks are. It's not just, not everybody goes and downloads financial statements and reads them and understands them. I think people are really looking to voices, in traditional finance and crypto to learn and understand.
So what risks would customers face if they wanted to go to WonderFi, or would they face any? What kind of confidence would they have that they're not going to get Voyager and we're not going to see this sort of Celsius limitation of withdrawals? And then maybe second, if you could speak to how have signups been lately? Are you noticing at the business a little bit of a slowdown in the last few months?
Yeah, so definitely. So I'll answer the second part first, which is, generally, I think the whole crypto industry, all platforms have seen, a general decline this year, just with macroeconomic conditions and what's been happening in the crypto market as a result. So I think, generally there's, a bit of a softer market right now, but nothing that we haven't seen before. And in terms of confidence for customers, we don't lend out any customer assets. No, we've never done that, nor will we do that unless we find a way that is vetted and approved by regulators, that has, doesn't have the risk profile of some of these incidences. But it's not part of the plan right now. I think our business really focuses around providing a simple, compliant way for people to trade crypto and just making it as dead simple as possible. And so I think some of the strategies, the high risk strategies that you've seen with some of the names in the news recently, those are people that, companies that were chasing, higher revenue, higher returns, and offering things that were unsustainable for customers, like 20%, yields on their crypto assets. So that's something that right now we're not even allowed to do that, because we're regulated, and we would need to, we need to get through a process with the regulator to be able to do that. And now, in light of these incidents, for us to get through a process with a regulator to be able to offer a lending yield product through BitBuy or through Coinberry, the regulators are going to now have to get comfortable with all of all the risks that we're seeing come out of these situations. So it's going to be a long process before we would be able to do that.
Got it. I want to talk now broadly about the crypto market. Kevin O'Leary, your thoughts on how low can Bitcoin go? Are we going to 13K? Kathy Wood says 22,000 should have been the 200-week moving average floor, and that would have been tough to go through. We blew right through that. We're going to 13. When do we go bullish here? Do we buy the dip or do we wait?
It's impossible to know, where the bottom is. But I would say this: I don't believe we've seen the bottom yet, and I have a different view of it. I go back again to other asset classes that I've invested in for decades. In every case, traditional bonds, traditional equities, real estate, alternative asset classes, bottoms are reached with an event, a panic event, as I call it. And you can find it in every asset class. Back in the hedge fund days, when they started gating, these large multi-billion-dollar hedge funds that gated, shut down their liquidity, caused panic, and you saw bottoms in equities as they were being liquidated. There's long-term was one of the classics in the last couple of decades. And it was a fund that was over-levered and blew up. We haven't seen that yet in crypto land. There's no big guy has gone to zero yet, and I think that's still to come. Hard to say who it is, because it's going to be because of leverage and some kind of relationship in a counterparty holding that they have not disclosed. And I'm just speculating right now, but that would be very healthy for the market to have that happen. Voyager's too small. It doesn't matter. The rest of these guys were kind of irrelevant in terms of total market cap. Bitcoin and the crypto market itself has almost been cut in half in total market cap. And so you would think we're on our way to the bottom, but I like a big panic event. That's always been a great way to bottom. It's towel throwing, it's capitulation, it's massive volume, it's total panic in the streets, and always a great buying opportunity. I have no idea who's next. Could be tomorrow morning, could be a month from now, but it's coming to a theater near you. And it will definitely be a very good thing for this industry. It'll be a great thing because it'll take out all of the bad, broken business models, the heavy leverage, the speculation that was too risky, and push everybody. And this kind of circles back to the conversation you were having with Ben at WonderFi. The reason I'm an investor in WonderFi is I need a place to store my crypto assets that fit into my compliance and accounting departments. And so, when WonderFi was able to offer me a centralized wallet at BitBuy, I was able to say to my auditors, look, you can audit this thing daily, weekly, quarterly, monthly, and I can mark to market each position for you at 4 o'clock, even though it's irrelevant in crypto land. It trades 24/7. But the old infrastructure of compliance that exists for all financial markets has not yet provided systems yet for anybody that wants to be compliant like I have to be. I don't have an option. I have to go through audit. I'm an investor in many other financial services companies that are issuers under regulations in many countries. We have to have our audit statements signed. And
Did I lose
I think
Kevin?
the audio cut out. Yeah. It's,
Kevin.
Kevin, we can't hear you.
I think we lost your audio there for the last maybe 30 seconds or so. In the meantime, while that gets fixed, Ben, your take, what's it going to take to get to a bottom?
I think these are definitely good signs that we're getting close to a bottom, and we'll have to see how Voyager, BlockFi, Celsius play out. I think there is a potential that some of those firms are going to have to liquidate large amounts of crypto, which would likely send the market down further. And to Kevin's point, we'll see what else comes up over the coming weeks. I know there's a lot of other firms that have been lending and using high risk strategies, and so it's also good as this more news about these firms comes out, because you do get more good analysis and information about the different strategies that they were using and the different risk profiles. So I think we'll learn a little bit more as we go forward and sort of see how big this issue really is, and then obviously the other part is the macro economic conditions, and I won't throw my guesses in on that. I feel like they're as good as anybody else's guess. So.
Got it. Kevin, do we have you back?
I think you do.
We do. Yeah, go ahead and finish your thought there. And it sounds to me, and maybe you can also address this, the follow-up question I had for you, which was, would you, after you finish your thought, say that you're looking for a big spike in the VIX in the stock market to find a bottom there as well?
Well, let's stay on crypto for a second. The point I was trying to make when I lost audio was that it's taken me a long time to convince my existing compliance and accounting infrastructure that supports my operating company's investments across a wide range of financial services to get on board with my positions in crypto. Because remember, I own WonderFi because I want to own infrastructure equity. Same for FTX, same for Circle. I'm a shareholder of those companies and Immutable Holdings in the NFT space. That's my basket of equities that are all compliant operations. They're all compliant. They all work under a very strict compliance. That's the test that starts the equity investment. But the more interesting challenge that I solved recently with WonderFi again, with BitBuy, was to actually open an account, transfer all of my projects, whether it was a Polygon or Helium or whatever. I mean, all this stuff to me, these are not coins. It's just software. That's all it is. Mm-hmm. And moved it into, and slowly I'm doing this, I'm not finished yet, into BitBuy, where I can get a statement each month that my auditor gets before I do, and my compliance department marks to market every day at 4 o'clock. And I find it so humorous that the whole compliance world still marks to market crypto at 4:01 p.m. as if that means anything, because it's trading 24/7. But they mark to market it because they have this giant infrastructure that reports back up: is there over leveraged positions? Is the position more than 5%? Depending on the mandate that it's held in. But this is what WonderFi is doing. It's working under the regulator, under an order, completely compliant. Actually has a public auditor looking at it now, signing my statements. That's a big deal. That did not happen for years. And that's why I'd rather invest there, because that's going to become more and more and more important as regulation comes. The large institutions that don't own any crypto need the WonderFis of the world, totally compliant, whether it's decentralized or centralized, and auditors that can actually use the infrastructure they're building to make sure they can mark to market according to the traditional rules of compliance.
There's a commenter here asking if your stance on NFTs has changed at all from the utility of NFTs related to cars or watches.
I'm still a huge fan of NFTs for authentication, not for trading. I have never, ever traded one until the regulator tells me if it's a commodity or a security, because I don't want to get caught in that debate. But I have used them. Last week, there was an art exhibit in New York, and I bought a piece. And I asked the dealer and the artist, I will not take delivery without an authentication NFT. And wow. They said, well, wait a second, we don't have one. I said, then you don't have a sale. I want that so I can send it to my insurance company. That's the way things are moving. I'm not trading that NFT. It's attached physically, if you want to think of it that way, to the piece of art I bought. It will trade when the physical art trades. But now I'm able to actually send the NFT to my insurance company and say, this is what I bought. This is when I bought it. Here are the attributes of it. Here's its physical location. It's on transportation now down to Florida to my home. And all of that is covered in this NFT. So that's the future of NFTs for me. You know, I don't know about an ape or any of that stuff, because to me, where's the intrinsic value there? Somebody tried to sell me an ape for $362,000. It's now worth 60. That's not good.
All right, last question, and then I'll open it up to just final comments from both of you. So this question for both of you: what happens when people like Sam Bankman Freed run out of money to keep bailing out companies in the industry, and maybe we do get that mass panic event? Are retail consumers going to want to be part of crypto when that event happens, or jump in, after that event happens? You first, Kevin O'Leary, then Ben.
Well, I have to disclose I'm a shareholder. Ben, you should be aware, is a shareholder in WonderFi as well. He came in around the same time I did. I am a paid spokesperson for FTX, so I have a lot of respect for the management there. I did a lot of due diligence before I accepted that position because I wanted to have a compliant home. But Sam is one of the smarter guys in this space for this reason. Long before crypto, he was a trader. He understands the power of leverage, both to the dark side and the upside of performance. So I'm going to guess, and it's a personal opinion, the last guy to blow up is going to be Sam Bankman Freed, because he doesn't get himself caught in over-levered positions. Now, they're very, very good in terms of managing their own business. He's got a huge team there. Ryan, the CEO. They also manage the Americas differently. They do the rest of the world. They're compliance. His parents are compliance lawyers at Stanford. I mean, he doesn't have a better heritage in terms of managing this process. So I think he's probably going to be one of the ones that picks up the pieces and has been doing that in recent purchases that are made public in various platforms that are just getting crushed. It's a long-term strategic move. I think it's smart.
Ben, your thoughts, liquidity, VC space, what are you seeing? What happens if Sam Bankman-Fried runs out of money, or will he?
Yeah, I think if Sam runs out of money, it would be interesting to see if other more traditional financial institutions step in to participate in bailing out some of these parties. I think that'll be interesting because we have seen a lot of financial institutions make big investments into the crypto space. So I think that'll be something to keep an eye on. Government involvement in bailouts. I don't necessarily know whether that's on the table, but I think that's the sort of lens that I'm looking at it through. And it'll be interesting to see how it plays out. I do think it is great to see Sam and FTX stepping up and hopefully being able to preserve some customer funds through the actions that they're taking. I think at the end of the day, we can look at this from an investor standpoint, from a user standpoint, whatever it is. But at the end of the day, there are lots of retail users of crypto, a lot of them first time, who are stuck out holding the bag and with amounts of money that are very significant to them. And so I think always looking at it from that lens is really important, because this is an asset class and a technology that is meant for mass adoption. It's meant for, to be a currency of the people. And so I think we should really never lose sight of that. So I think from that lens, what Sam is doing is fantastic, and hopefully he'll be able to keep the dollars in some people's pockets through FTX's actions.
Sounds great. Let's get some final thoughts from both of you, maybe 60 seconds each. Final thoughts on the crypto market. Are you waiting for that big panic, or what's the future? Do we still have a future in the crypto utility, crypto investing? Kevin O'Leary, we'll start with you. Final comments or pitches that you want to make, and then Ben, and then we will wrap it up.
I think crypto has a very bright future. I'll be bold enough to say in this very volatile market for crypto that within a decade, it'll be the 12th sector of the S&P. And the reason is there's just too much productivity, too much transparency, really strong vehicles for solving financial services problems that exist today, like transferring capital, as I talked about earlier. It's just too good and too efficient. And so it'll remain. The key is we need to get some policy. I think it'll happen first with stablecoins. And, you asked the question about the stock market. It's no different than the crypto market. The stock market is still a little expensive if you believe we're having a recession, probably fairly valued if you think we're having a soft landing. The trouble is nobody knows. So you're going to see this fibrillation going back and forth until we resolve that question and we know where the Fed stands in further rate hikes. But there are some great companies that have lost 20, 30, 40% of their value. And I have to admit, I'm nibbling in equities as well, just as I am in crypto. And so I can't call the bottom, but I don't use leverage. That's the secret sauce. Everybody's calling me up, want to lend me money. And I just say, no, Nanette, not interested.
Awesome. Ben, final comments from you?
So definitely crypto's not dead. Bitcoin's not dead. I think whenever we have situations like this or markets like this, we've heard that question come up time and time again over the last 10 years. And I think the way to look at it is you have these aggressive growth cycles and then these downturns where a lot of issues are resolved. Previously, it was with the technology in some cases. And then in more recent years, including this year, it'll be with regulation and sort of like really weeding out sort of, bad actors or people that are not operating in a way that's safe for customers. And so that's, looks like my camera jumped out there, but yeah. So I'll just finish the thought. So that is what we're seeing now, which is basically regulation is going to make things more stable and secure for users and investors in the space. And then once we get through this cycle, we'll see continued growth. So I think it's part of the natural growth of the asset class, and just with any type of newer technology, we tend to see these types of cycles.
Very well. Well, thank you both very much for your time. Ben from WonderFi, Kevin O'Leary. Go check out Kevin O'Leary's YouTube channel as well. I want to make it clear to everyone this video is not sponsored. I don't do sponsored interviews. And thank you both so much for the time. Links to both of your websites in the description down below. If, as the viewer, you found this helpful, consider sharing the video, and we'll see you in the next one.